everyone. Welcome back to another video lectures. So last time we already finished with chapter 12, right? And so today we're gonna start chapter 13. And I have decided to drop chapter 15. So exam 4 will be covering chapter 12 and chapter 13. And the reason I decided to do that because we only have like 2 weeks of classes. And I think the last day of class is going to be May 8th, right, which is Friday, next Friday. So I think it's not fair for you guys to study like 3 chapters in 2 weeks times. I don't like that. So yeah, so that's why I decided to drop chapter 15, and exam 4 will only cover chapter 12 and chapter 13, right? So I hope that makes it easier for you guys. Um, all right, so I guess let's start, right? So last time in chapter 12 we talk about different types of entities, and how are they different from each other, right? So chapter 13, we'll talk about corporation, right? How to form a corporation and how do we file tax for corporation? How do we calculate tax for a corporation? Just an overview. Because I'm sure you guys going to study corporate tax in her higher level class. So what I want to do now is just to give you an overview, give you an introduction of the concept that involved in corporate tax. All right. So it should not be too complex. I know you're gonna go very deep into that in corporate tax class, but the goal for today is to give you an overview, of what you can expect in the corporate tax class. All right. So throughout the chapters, I think we're going to talk about how, first of all, how to form a corporation, right? And by forming, I means how do people like what do we do? What do we do in terms of tax when people want to form a corporation? What do we do when they contribute to a corporation? So when a group of people contribute a certain property, certain asset to form a corporation, right? So that's the first part, and then the second part, we're going to talk about the basic concept of tax calculation for a corporation. We're going to go over the tax formula, and we're going to go over the book tax differences, right? And then we're going to talk about like some of the important items regarding to book tax differences, right? So that's going to be our plan for chapter 13, right? So my goal is probably cover half of the chapters in this video lectures, and then probably I will create another video to cover the remaining of the chapters. All right, so let's go. All right, so um, first of all, let's talk about section 12, 51, facilitate corporate. Usually when people form a corporation, they're gonna try to transfer some asset, right, or some properties to the business, right? It can be their personal properties, and now they want a share on the piece of they want to be a shareholder of the corporation, so that's why they contribute um, their asset, their cash, in exchange to receive a piece of a certain amount of share from the corporation, So usually people have to recognize when they do such exchanges, they have to recognize gain and recognize losses, you know. But if the transaction qualify, if the property qualify, if the transaction qualify for section 351, then the gain is going to be deferred. The gain, they don't have to recognize the gain right away, right? So basically, you remember we talk about like kind exchange, right? So even though this is not exactly like kind exchange, because the shareholders contributing an asset and in exchange for a share, right? It's not a like kind per se, but the way we treat it is similar to a like kind chain transaction, right? So when if if the transaction qualify for section 351, um, then the gain and the losses, if the shareholders recognize, if the shareholder realize during the transaction, then they don't have to recognize it right away, right? So what is um, how do section 12 of 351, what exactly does it do, and what are the qualification, what is the requirement for a transaction to meet this section 351, right? So we're going to talk about that now. Changing a piece of properties uh, and in exchange for certain amount of shares from the company, right? And then later on we're going to talk about boot, just like kind of change, right? But we're going to talk about that in a few slides, right? But right now we're talking about a pure exchange, a pure transaction. Uh, the shareholder going to transfer a piece of asset in exchange for for a certain number of shares, right? So um, all right. So yeah, so like I said, the tax basis of the stock is going to be exactly equal to the stock, to the tax basis of the contributed properties. So let's say if I want to buy a certain share, you know, in corporation A, right? So, and then I contribute my cars, and I contribute on top of that, I contribute, let's say, $20,000 cash, right? And my car was $5,000, so in total, my basis for the properties, for the asset I transfer to the corporation is $25,000, right? So when I receive the stock, I'm going to treat the stock basis as exactly $25,000, right? And remember that what we talk about here is the pure transaction, right? I give the corporation my properties, right? And I receive a share, right? Um, so that tax basis, and in terms of the holding period, the the holding period of the stock that the shareholder received, right? It can include the holding period of the property as well, right? So like I said, in my case, when I transfer the car to the corporation, right? And then when I receive the stock, the holding period, I can treat the stock uh, also include the holding period of the car that I own, right? So let's say I own the car for 5 years already, and then after 5 years I transfer the car to the corporation, and then I receive 5 share back, right? So now the holding period on this 5 shares is going to include the 5 years that I have my car, right? So now let's say if I want to sell the share, then I can treat the gain as a long-term capital gain, right? Because the holding period now is 5 years, right? Even though I just received the share, right? Right. And let's see. All right. So basically, there's three requirements, right? So the first requirement is there has to be a transfer of property to the corporation, and I want to emphasize the properties here. Right? It cannot be a service, right? It has to be properties, right? The shareholder has to transfer a piece of properties to the company, right? Because sometimes sometimes shareholder can exchange services for share, right? And that happen a lot when say like nowadays, like when company give out compensation as give out share as compensation, right? Um, so especially in the term of form during the time of forming the corporation, um, right? So for example, let's say Facebook, right? Let's say when back then when they started Facebook, right? Basically the asset of Facebook doesn't have much. You know, all they need is just a room and a bunch of computers. You know, so the hard core, the hard asset, right? The properties that people can contribute is not much, right? However, the team of founders, um, they put in a lot of effort. They work day and night to set up the company, right? So um, for them, a lot of people, right? For a lot of the first employee, the first group of people, they are changing their services for in return, they're going to receive some share of the companies, right? So in that case, that kind of transaction cannot qualify as Section 351. You know, so only properties transfers can qualify for Section 351. Right? So that's the first requirement. The second requirement is that um, is going to be treated as boot, right? We talked about boot the last time already, right? So boot is anything that are not can be considered as a qualified properties, right? In this case, stocks, right? Um, so yeah, so when the transaction involve boot, then um, it is not a purely properties to stock exchange anymore, and the involvement of boot can cause the shareholders to recognize the gain, right? But yeah, but we're gonna talk about that in a few minutes, right? But so keep in mind the second requirement for Section 351 is the shareholder have to receive stock in exchange, right? Not other non-qualifying stuff, all right? And what is the third requirement, right? So the third requirement is probably the most important requirement and the trickiest kind of requirement for shareholders, you know. So it says the transfers of properties must be in control in aggregate, right, of the corporation immediately after the transfer, right? So what is what does control mean, right? The control means the ownership of 80% or more of the corporation voting stock and each class of non-voting stock, right? So it doesn't matter whether or not it is a voting or non-voting class of stock. The all the transferor in as a whole, right, in aggregate, have to own more than 80% of the companies, basically, right? And immediately after the transfer, right? So, uh, all right, so what can be an example? So let's say there are five people, you know, five shareholders, right? And each shareholders. So let's say let's say I am the founder of the company, the corporation, and then I invite four other people to join me to form this corporation, right? And because I'm the one with the idea, so I don't contribute anything, and then I want other people to contribute properties, right? So each people contribute their properties, and I give them 20% each, so four people actually contributing properties to the corporation, and now all four of them owns 80% as a group, right? So now for those shareholders, they can the transaction that they did can be qualified as Section 351, right? All right. Yeah, so that's just like a basic example, but we're gonna have an example in a bit, right? But first, let's look at this problems, right? So it says when incorporating CCS, which is the corporation, right? The co-transfer a parcel of land held as an investment for 5 years. So this is a capital asset, right? To CCS, the company, in exchange for 50% of the corporation's stock, 50 share at with a value of $100,000. The land fair market value was $100,000, and its tax basis to Nicole was $40,000. And assume the transfer qualifies under Section 351. So the question asks, what is the gain and losses? Does Nicole recognize on the transfer? What is her basis in the stock she received on the exchange, and what is her holding period in the stock? Right. So we know that this transaction qualify for Section 351, right? They already tell us, right? Um, so the first question, what gain or losses does Nicole recognize on the transfer? The answer is none, right? Because the transaction qualify for Section 351. So whatever gain that she received, she realized it's going to be deferred, right? She don't have to recognize the gain right away, right? Even though she has like her basis was $40,000. The share she received was $100,000. So basically, she realized a $60,000 of gain, right? But because the transaction qualified for Section 351, so she doesn't have to recognize the transfer, the gain on the transfer. All right. What about the second questions? What is her basis in the stock she received on the exchange rate? So, like I said, this is a pure transfer of property for stock, right? So the basis of the stock received is going to be equal the basis of the property exchange rate. So in this case, the basis of the stock that Nicole receives is going to be $40,000, right? Which is the basis of the land that she contributes to the company. All right. And what is the holding period in the stock? So we know that this parcel of land she held for investment, right? And she already owned it for 5 years. So this is going to be a long-term a capital asset, right? Pretty much, right? So that's why her holding period in the stock going to include the the 5 years holding period that she already had on the parcel of land, right? So yeah, zero gain and $40,000 basically in the stock, right? And as this is the pure transaction, right? There's no booting involved, so she don't have to recognize any gain, right? And then her holding period is gonna include the 5 year period that she has on the land. All right. All right. And so let's look at the next scenario. Right? So here are the scenario where we have to judge whether or not the the transaction qualify as Section 351 items. So let's see, right? So say suppose Sarah received 25% of CCS um, in exchange for the services. Nicole received 50% of the CCS stock in exchange for appreciated land, and Chance Incorporation received 25% of CCS stock in exchange for cash. Right. So it asks, must Nicole recognize the gain she realized on her transfer appreciated on land, appreciated land, right? So we can see um, there's three shareholders here. There's Sarah, there's Nicole, and there's another corporation who buy bought the share, right? Chance Incorporated, right? And then we know Sarah, she exchanged her service for the stock, whereas Nicole and Chance Incorporated, right? The Chance company, they exchange properties to receive stock, right? And Nicole and Chance only altogether, right? Only own 75% of the companies. So um, so for the third requirement, they fail there, right? So that means this transfer cannot be treated as section 351, right? So that's why they have to recognize gain. So yes, they have to recognize the gain, right? Okay, so let's see. There's the next scenario. So the next scenario says, suppose Sarah received 10% of the CCS stock in exchange for services, right? And she received 50%, 15% of the CCS stock in exchange for cash. And she transferred both services and property to CCS, right? Also, Nicole received 50% of CCS, and Chan received 25% of CCS, right? So, um, so it asks much Nicole gain, recognized gain on her transfer of the appreciated land, right? So now, in this case, it's a little bit different, right? So now we know Sarah, even though she still received 25%, but only 10% of that is out of services, right? And then she received 50% in exchange for the cash that she contribute to the company, right? The corporation, right? So now in total, all three of them own the 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 amount of share that has been issued in exchange for properties, right? For properties. Now altogether, it's worth like 90%, right? So that's why right, we have 15% plus 50% plus 25% here, right? So that's why this transfer, right, can be considered as section 351, and so Nico don't have to recognize any gain on the transfer, right? Right now, right? So um, yeah, so I hope this scenario, this example, give you a better idea, a good idea of how this section 351 work, right? And the requirement that need to be met uh, for transaction for transfer to be considered as section 351. All right. So let's see. Right. So now let's talk about the case when there's a boot involved, right? So the boot involved happens when, like I said before, right, when there's more than stock, when there's not only stock involved, but there's also other properties exchange, right? So let's say a shareholder contribute some properties, right, and in exchange the corporation give them stocks and some other properties, right, either cash or some other properties, right? So that is in that case there's a boot involved, right, because the corporation is giving something to the shareholders other than the stocks, right? So now there's boot involved, and so um, similar to like an exchange, the shareholders have to recognize the gain to the extent of the boot involved, right? And if the gain realized is smaller than the fair market value of the boot, then you have to recognize all the realized gain as yeah, you have to recognize all the realized gain, right? And then pay tax on it, right? But if the gain realized smaller is larger than the fair market value of the boot, then you have to recognize the, the, the gain to the extent of the boot involved, right? All right. So um, the process of of characterizing the gain has to be determined by an asset asset by asset basis, right? So basically, you have to look through each property transfer determine whether or not it is a capital asset or whether or not it is an ordinary asset, right? To calculate the gain on that, right? You cannot just like consider the whole bundle of asset that transfer and calculate gain on it. We have to look at each individual asset or properties transfer, right, to calculate the gain or the losses that the transferor, the shareholders um, realize on the transaction, right? Um, and when there's multiple properties transfer, right, meaning the shareholder give the corporation multiple items, multiple properties. The boot in Section 351 transaction must be allocated to the property exchange on a pro rata basis, right? And what it is, we're going to talk about that a little bit through 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 an example. Right? So all of this, I think, is better explained through an example. So we're gonna do a do an example in a bit. So right, so what's the important thing that we need to know from this, right? We have to know the most important thing is if there's boot involved, meaning if the corporation give the shareholders not only stocks but also some other form of properties, right? Either cash or something else, right? Then the shareholder have to recognize the gain to the extent of the boot, right? But only recognize gain and then loss doesn't apply here, right? So, all right, and well, like I said, the the characterized gain, it has to be depend on, it has to be done on a asset by asset basis, right? So basically look at each individual asset, consider what type of asset it is, and then you characterize the gain or the losses based on the characteristic of the asset, right? Based on the type of asset, right? And then the boot receipt, usually we just use the fair market value of the boot to to calculate this whole process, right? All right, so let's look at this example. Let me blow it up, make it easier to see. So the first case, it asks, suppose Nicole contributed land she held as an investment with a fair market value of $90,000 and basis of $40,000, and inventory with a fair market value of $30,000 and a basis of $26,000 to CCS in exchange for 50% of the stock, and this 50% worth $100,000, and $20,000 cash in a qualifying 351 exchange, right? So what percentage of the $120,000 value received by Nicole was received for the land and the inventory respectively, right? So well, we know that only $100,000 of um, of stock has been received by Nicole, right? So so we can only use that to start with, right? So we know the stock received is $100,000, and then the boot, right, the cash received is $20,000, right? So so now the first question asks, what is the percentage of $120,000 value perceived by Nicole received for the land and the inventory, right? So we have to distribute this to each asset, right? And how we do it, we use the basis, um, or we use the fair market value of the properties to calculate a kind of like a ratio, right? So in here we have $90,000 coming from the land, right? Out of the total $120,000 transferred, right? So we take $90,000 divided by $120,000, and that gives us 75%, right? And then the rest $30,000, which come out as 25%, right? So that's answer the first questions, right? And the second question asks, what amount of gain does Nicole recognize on the exchange, right? And what is the character of the gain, right? So we know Nicole received the $20,000 boot in this case, right? So that's why she had to recognize the gain up to $20,000, right? So how much gain does she realize from this, right? So like I mentioned before, we have to look at each individual asset transfer, right, to calculate the gain realized and to characterize the gain, right? So first, in here, they do it separately here for her already, right? So for land, the amount realized from the stock was $75,000, right? And then the amount realized from the boot is $50,000. And the reason we can do that is we just times the $100,000 and the $20,000 by 75%, right? So that gives us the 75, the 50,000 here. And so the total amount realized when we come out to $90,000, right? So the adjusted basis was $40,000. The gain realized is going to be $50,000, right? We have 90 subtract 40, right? And then the boot received is $15,000, right? Because we have 75% of the $20,000, the boot right here, right? So in here we have gain realized larger than boot received. So we have to recognize the gain to the extent of the boot received, right? Which is $50,000, right? And the land, since it is since Nicole has held as an investment for quite some time now, so it can be considered as a capital asset, right? So because of that, the gain she can recognize this $50,000 gain as a capital gain, right? And she may be able to um, yeah, she will be able to pay a preferential rate on that, right? On the $50,000, right? And then for the inventory, we again we apply the whole process rate. So we know the amount realized from land for inventory is going to be $25,000, and the amount realized from boot is going to be $5,000, right? And this comes off because we just times the $90,000, the $100,000 and the $20,000 times it by 25%, right? Um, so that's how we get to these numbers. So the total amount realized for the inventory is going to be $30,000, and we know the inventory has adjusted basis of $26,000. So the gain realized is going to be 4,000, and then the boot received is $5,000, right? So in this case, the gain realized smaller than the boot received, right? So that means we had to recognize the total amount of gain realized on this inventory, right? And see, inventory, it is ordinary asset, right? So that's why we have to classify the $4,000 gain on this, in this case, on the exchange of inventory as ordinary gain, and the taxpayer had to pay ordinary tax on it. So yeah, so I hope so I hope this example clarifies how do we treat, how do we recognize gain, how do we treat the transaction when there's boot involved, right? All right. So what happened when the shareholders liabilities is assumed by the corporation, right? So this is the case where let's say um, the shareholders contribute a property to the corporation, right? And then on the properties there's still some debt involved with that properties, right? So for example, say I contribute my car, which I have owned for 5 years, right? And I have been to the corporation, and I have been paying my payments to the car. Right? I borrow money from the bank to buy the car, and every month I have to pay. I have my car payments, right? So at the time when I contributed the car to the corporation, the bank still I still owe the bank let's say $1,000, right? So now um, when I transfer the car to the corporation, now the corporation has to also assume my liability to the bank, right? And then they have to pay the bank that $1,000 that I have left on the car, right? So usually the general rule is that shareholder liability attached to the properties cannot be treated as boot, you know, meaning even though you can say it is put, right? Because the corporation doesn't does not only give me the share back, right? They also give me a debt relief, basically, right? So the debt relief part has to be, since it's not stock, right? It can be considered as put, but the rule said you don't have to treat the debt relief as put, meaning you don't have to recognize the gain on there, right? However, there's some exceptional cases, right? So for cases of liability assumption that has tax avoidance purpose involved, then or there's the liability assumption has no business purpose, then the taxpayer have to recognize the amount of debt relief uh, involved in the transaction, right? So very simple case, right? I'm not sure if I have a yeah, oh yeah, I have an example on here, right? So um, let's see, right? So suppose when incorporating CCS, Nico transfer a parcel of land to CCS in exchange for 50% of the corporation stock, right? Which was $100,000. The land fair market value was $120,000, and its adjusted tax basis to Nicole was $40,000. And the land was subject to a $20,000 mortgage that CCS assumed on the transfer, right? And Nicole borrowed $20,000 from a bank using the land as collateral shortly, remember, before transferring the land to the CCS, and then she used the mortgage proceed to pay for her new car. Um, so assuming the transfer qualifies under Section 351 and that the mortgage has a tax avoidance purpose, what gain or loss does Nicole recognize on the transfer rate? So first of all, why is this? Um, why does this transaction has tax avoidance purpose, right? So in this case, you see, Nicole, in this case she gets sneaky, right? She borrow money right before she transfer the land, right? She used the land as a collateral, borrow $20,000, and then transfer that to the corporation, right? So that's why in this case the corporation only pay her $100,000 worth of stock, and they assume the $20,000 of debt, right? So that brings it to $120,000. Right? That's why this is still a fair transaction, right? Even though the market value of the land is $120,000, the corporation only give her $100,000 worth of stock and $20,000 of debt relief, right? So why this is a tax avoidance case, right? So instead of so if Nicole doesn't borrow money from the bank, they got take out a mortgage, she just contribute the land, right? Then um, the company had to pay her, the corporation had to pay her, had to deliver to her first the stock, right, the $100,000 worth of stock, and probably $20,000 cash, right? So now she had the $20,000 cash put, and she has to recognize gain on the $20,000, right? But instead of receiving a $20,000 cash, in this case, Nicole received a $20,000 debt relief, right? So she thought that she don't have to pay tax on it, right? But because what she does is tax avoiding, right? Because she avoid to pay the tax on the $20,000. Had she received cash, right? But she chose to do the debt relief thing, so that's why it is a tax avoiding purpose transaction, right? And then Nicole had to recognize the $20,000 gain, right? And so in this case, it has both elements, right? It has tax avoiding purpose, and also it has she used the loan to buy car, right? So it has personal purpose anyway. Assumption of liabilities, right? Um, but the liabilities is just the amount of liability is just bigger than the amount basis that the shareholder has on the properties, right? So in that case, the shareholder have to recognize the gain to the extent that the liabilities assumed by the corporation, right? By the corporation in excess of the aggregate basis of the property contribute, right? So if the basis of the taxpayers in the property is, let's say, $5,000, and then the debt on the debt associated with this property is $6,000, right? So the shareholder have to recognize the the $1,000 that that exceeds the $5,000 of basis that the shareholder has on the properties, right? So let's look at this example, right? So we say, suppose that when forming CCS, Nico transfer parcel of land held as an investment to CCS in exchange for 50% of the stock. The land fair market value was $150,000, right? And then the stock value is still $100,000. And then its adjusted basis to Nicole was $40,000. And the land was subject to a $50,000 mortgage to CCS. $50,000 mortgage that CCS assumed on the transfer, right? And this is not treated as boot, right? Because there's no tax avoidance purpose or anything involved here. It's just a mortgage that she took out, you know. So the land was subject to a $50,000 mortgage that CCS assumed on the transfer, and this is not treated as boot. So it's assume that the transfer qualifies under Section 351. And what is the amount and character of the gain that Nico recognizes on the exchange, right? So in this case, the corporation assuming her liabilities of $50,000, right? And even though this is treated as a pure Section 351 as transactions, you know, there's no tax avoidance, no personal purpose involved in this transaction, right? But because the mortgage is $50,000, which is $10,000 more than the basis that Nico has on in the land, right, in the properties, that's why Nicole had to recognize a $10,000 gain, right, which is the amount that exceeds her $40,000 basis, right? All right, so yeah, but it's fairly simple, right? So assume you ask something like this on a test, I should expect you guys can do it. All right. All right. So next, let's talk about the shareholder basis in the stock received, right? So remember, at the beginning of the lectures, we talk about the basis of the stock, right? It's going to be equal the basis of the properties transferred, right? But that is like a pure transaction, right? Like I mentioned before, right? It's a pure transaction when someone transfer a piece of land, transfer properties, and then in exchange, the shareholder going to receive some stocks, right? But as we discussed earlier, that is not usually the only case that happens, right? There's other cases where the shareholder is gonna receive boot, right? So in that case, the basis of the stock can be trickier to calculate, right? So luckily there's a formula, a simplified formula that we can follow to calculate the basis of the basis in the stock, right? So um, here's the formula, right? So cash contributed, right? Cash contributed to the corporation, right? Plus tax basis of other properties contributed, right? Plus gain recognized on the transfer, all right? Subtract fair market value of boot received for the stock, and subtract the liabilities assumed by the corporation on the properties contributed, right? So the end result is going to give us a tax basis of stock received, all right? So this is like a simplified formulas that we can easily use to apply it to calculate the tax basis of of the stock, right? In case in case of a complex transaction, where there's multiple properties involved, there's liability assumed by the corporation, there's boot involved as well, right? So you can use this formula to calculate the tax basis of the stock, right? Right. So so what about the corporation, right? What is the asset? What is the basis that the corporation have on the asset that they receive from the contributor, from the shareholders, right? So the asset usually has the basis. The corporation usually use the basis of the shareholders to to treat as the basis rate. And if there's any gain recognized during the transaction, then they also have to add the gain recognized to the basis um, of the shareholders, right? So basically, the basis of the asset usually is the basis that the shareholder has on the property plus the gain recognized, if any, right, by the shareholders, right? And then usually the holding periods of the stock of the asset that the corporation just received from the shareholders also include the shareholder holding period, right? So earlier I say I contribute my car, which I have owned 5 years, to the corporation, and so now the corporation, when they um, considering their holding period, they can also include the 5 years period when I hold my car, when I have my car, right, before I contributed to the corporation. All right. So let's say when they later on they want to sell the car, they can treat the car as a um, they can use the holding period, as to calculate to characterize the which type of asset the car will be, right, when they sell the car. Oops, sorry, my PowerPoint froze. All right, all right. So let's talk about the case when the shareholders only contribute assets without receiving any stock in return, right? So uh, that's what we call contribution to capital, right? So that's a transfer, that's a transaction when that's a transfer of properties from the shareholder to the corporation, but there's no stock in return, right? So in that case, um, the shareholder is gonna, if the shareholder has already have some stock of this corporation, and usually that's the case, right? The shareholder basis in the existing stock that they owned can be increased by um, by the tax basis of the property that they contributed, right, without receiving any stock, right? So let's say I already contributed my car to receive $1,000 worth of stock in the corporation, and then later on I also contributed a second car, let's say, right? But doesn't receive any stock in return, right? And then the second car worth $3,000, right? So um, because I because the second time I contributed, I didn't receive any stock in return. So now I can increase my basis in the stock that I have owned by exchanging the first car, right? So the stock. So the first time I exchanging the $1,000 car to receive the stock, right? So the stock, my basis in the stock is going to be my basis in the stock was $5,000, right? And then now I contributed another car to the company without receiving any stock, and the car basis is $3,000. So now I can improve my basis in the stock from $5,000 to $8,000, right? Um, and this is gonna help me how this is gonna help me when, say, I decide to sell the stock, right? Since my basis can be high, then I'm gonna reduce the amount of gain I recognize on the transaction, right? So that can help me to pay less tax, right? So Um, what else? So when the corporation does not recognize the gain, well, when the corporation doesn't pay out stock when they're receiving some plan, right? They cannot they don't have to recognize the gain, and usually they take the carryover tax basis of the property that they have been contributed, right? Um, so like in the example, in the case when I contribute the second car, right, the $3,000 car to the corporation, the corporation gonna use my basis in the car, which is $3,000, as the basis for the car when they enter the asset in their book, right? Um, all right. Oh, and then when the case, what if the corporation receives some properties contributed by non-shareholders, and that happened a lot of time when, say, a corporation open their business in a location, and then maybe the local government want to lure them in, or to help them, so they give them a piece of land for to set up their operation there, right? So in that case, the local government is not the shareholders, right? But they contributed land to the corporation. So in that case, the corporation had to recognize gain on the properties that they received, right? Um, so yeah, so all right. So that was the first kind of main item of the chapters, what we just talked about, right? How do we treat, how do we recognize gain? What do we do when shareholders start to want to form a corporation, and then they contribute asset, right, to to form the corporation, and in exchange for the share of the company, right? So that was I would say the first half of the chapters, right? And then in the second part, let's talk about how can we calculate tax for a corporation, right? And then let's talk about, we're going to go more in detail about book tax differences, right? So here's the tax formula for corporate tax, right? And here's the formula for individual tax, right? So as you can see, they are fairly similar, right? Except for this part, right? So for corporate tax, there's no AGI, right? There's no formal AGIs and no full AGI deduction. So everything for them is either deduction, or later on we see it can be some addition as well, right? It's not, it can be addition and it can be deductions, right? So, and then other than that, after the point of taxable income, then it's fairly similar, right? But then the tax rate for corporation is the flat rate of 21%, right? So it's different, right? But as you can see, the structure of the formula should be fairly similar, right? Except for this part. Right? So what is this? So this is the what we call um, book tax differences, right? Book tax adjustments, right? Because as we kind of have already mentioned a little bit before, right? We know that financial accounting and tax accounting are different, right? So when we consider corporate tax, when we calculate corporate tax, we have to start with the gross income, right? Which is the income reported for financial purpose, right? And then we have to make some adjustment because the financial income is different from the tax income, right? Because the two systems are very different, right? So to be able to calculate the taxable income here, we have to make some adjustment, right? And that's what we call book tax differences, right? The differences between book, which is financial reporting, accounting, and tax accounting, right? So yeah, to get to taxable income, we start with financial income, right? And then we reconcile by adding or subtracting the differences, right? Um, so there are two types of adjustment, the two type of book tax differences. That's favorable and that's unfavorable, right? And unfavorable mean we had to add back to the book income to compute the taxable income. And favorable is we can subtract the item from book income to get to taxable income. And the reason why we call it favorable and unfavorable is, meaning, so for favorable adjustment, it's going to bring down the taxable income, meaning we don't have to pay, we can reduce the tax liabilities for this kind of adjustment. But for unfavorable adjustment, we have to add back, right? let's add more item into the taxable income, meaning we're going to increase the taxable income, and we have to pay more tax on the taxable income, right? And then on top of that, there's permanent differences and temporary differences. Right? So permanent differences mean the differences between book and tax is permanent. There's no way it's going to disappear, right? So it's by default, it's just difference, right? So for example, income from municipal bond, right? Municipal bond interest income, right? So for book purpose, you have to include that in the income, right? But for tax purpose, since municipal bond in interest income is not taxable, and you have to subtract municipal bond interest income from financial income to calculate taxable income, right? So that what I just said, right? The municipal bond is going to be an example of permanent favorable adjustment, right? So there are here's a list of a few common items for permanent book tax difference. So federal income tax expense. So for book purpose, you have to use it as an expense. You can use it as expense, to reduce your income. Right? But for book purpose, for tax purpose, you cannot include that, right? You cannot include that expense. So meaning you cannot deduct the federal income tax as a deduction. Right? So that's why it's unfavorable. Right? Interest income for municipal bond, we just talked about, right? It's going to be a favorable book tax difference, right? And then there's a lot of other stuff, right? For example, death benefit from life insurance on key employees, interest expense on loan to acquire investment that generating tax exempt income, right? So we just talked about this in previous chapters or 2 or 3 chapters ago, right? Meal expense, right? We know business meal expense can only be deducted by 50%, right? So it's going to be a permanent unfavorable book tax differences, right? And entertainment expense, we know for tax purpose we cannot deduct that, right? But for book purpose we can use that expense. We can recognize that expense to reduce our financial income, right? Fines, penalty, and political contribution. Well, for financial purpose we can use that, right? We can recognize those expenses, but for tax purpose we cannot, right? So here's just some example of permanent book tax differences, and then here's some example of some of the common example of temporary book tax differences. Right? So the reason is called temporary because it's only create the differences right now, right, at the moment, and then in the futures that difference can be reversed, right? So for example, depreciation, let's say, right? So for tax purpose, we know the depreciation expense is much higher than the depreciation expense for book purpose, right? For tax purpose, it's much higher, right? That's why it's favorable, right? But then over the course of time, after we use it, right? After we finally fully depreciate the asset, right? Then it doesn't matter book purpose or tax purpose. If we fully depreciate the asset, then the asset going to become zero. Right? The basis is going to become zero anyway. So in that case, the differences between book and tax difference is gradually reversed, right? And at the end, we have the same amount, right? Let's say we fully depreciate a $5,000 cars, right? So it doesn't matter which method you use at the end, the basis we have on the car is going to be zero, right? So so throughout the depreciating process, the difference between book and tax is going to be reversed, right? And at the end, the end result is going to be pretty much the same, right? So yeah, so there are many other um, differences, right? So say gain or loss on disposition of depreciable assets, better expense, unearned revenue, right? So for example, unearned revenue for financial purpose we cannot recognize unearned revenue, right? But for book purpose, in some cases we have to recognize the unearned revenue, right? So meaning we have to pay more tax. So that's why it's an unfavorable, right? But when when the revenue is earned later on, right? Then the difference is going to be reversed anyway, right? So yeah, so remember, for temporary, the differences only exist for a short amount of time, and in the futures, the difference is going to reverse and disappear, right? So I think this is a good start where we can stop this video, and then in the next video I will continue to discuss more detail um, into each item. Well, not each item, but we're gonna discuss some of the main important book type differences. And then yeah, and then we will wrap up chapter 13 in the next video. And then after these chapters, similar to last time, to every other test, I want to make a review session video, and I hope, yeah, and I'm gonna give our review notes, so in that way you can better prepare yourself for the final, right? It's not final, it's exam 4, right? Which only cover chapter 12 and chapter 13, and I still don't know what I'm gonna do to the chapter 15 homework, and a little smart, because we're not gonna cover it, so I cannot assign you any homework or on that chapters, right? But then it's gonna create a hole on your grade books, right? You're gonna lack like 12 points or 15 points for that chapter, right? So I still don't know what I want to do, but I think I may just give you guys those points for free, as a bonus. Everyone gonna receive points for chapter 15. Maybe that whatever I will do, But I'll give it some more thought, and then I will let you know. So all right. So let me know if you have any questions. Email me. Um, other than that, I'll see you in the next video. All right. Take care.